I've been in the forex industry for over 3 years. As a funded trader, I've made thousands of dollars in the forex market. So in this video, I'm going to show you how to determine the directional bias of the forex market using 3 different methods. And the last method is actually the most accurate. So I need you to stick around. I see a lot of forex traders being confused about the direction of the market. But after watching the video, I can guarantee you that you're not going to have any issues with determining the direction of the market. So the first method is actually using the trend line. So the trend line is a tool in the forex market that connects the lows, maybe 2 or more lows or 2 or more highs together to in order to determine the direction of the market. But before that, what was important about determining the directional bias of the market is you must understand the importance of the higher time frames. Right? So for instance, as a day trader, your higher time frame you look out for when determining your directional bias is actually the daily time frame. The daily time frame or the 4 hours time frame, or you use both. So for now, I'm going to focus as a day trader. So other traders like the swing trader and others, they would focus on a higher one. But this video is probably for those that are day traders. So if you want to time your directional bias, you must first go to the higher time, which is your daily or the 4 hours time frame. So now that you understand the power of the higher time frame in determining the directional bias, so let's get right in on the first method of determining the directional bias of the market. So actually, the first method is using the trend line. So a trend line is a line that connects the swing lows or the swing highs of the market depending on the direction of the market. So for instance, as a teacher, I'm actually on the daily time frame. So if I'm going to use the trend line to determine my directional bias, I'm going to pick it and I'm going to connect at least 2 lows, this and this, and I'll now draw it down. Right. So now this method is the least accurate method of determining the directional bias, and that's, it can be used for a couple of years. So it's one of the least accurate, but it's very, very effective also. For instance, if you look at this, you can see that when price actually broke the trend line, it actually came and retested it, and now it's now going down to the downside. Right. So it's one of the least, but it's also very, very important. So if you understand how to use the trend line in determining your directional bias, I want you to leave a comment down below. Say I use trend line in determining my directional bias. So actually, when I started as a day trader, right, this was what I was actually using, but eventually I saw that it was not favoring me. But one thing good thing about traders is that one method will be good for you, another one may not be good for you. Right? But I actually use this to actually make a lot of money. But now that I've been in the market for a very long period of time, I don't use this method, but this method still works for those that understand how to use it. So I've said if you understand how to use the trend line to determine the directional bias of the market, I'd like you to leave a comment down below and tell us how you use it. Right, so let's get to the second method. So the second method is using the moving average. So the moving average is an indicator. So I see a lot of traders condemning the use of indicators. Now, indicators are still valid. Those people that know how to use it know how to use it. But one of the things I condemn about indicators is the fact that a lot of people, they use so much indicators. So the moving average, so this is how you're going to use it. So you come to the indicator, you come here, then you type moving average. So you can see this simple moving average. So you can click on it. But this is where it is right here. So you click on, after you click on it, you come out here. So you can see it, but this is not how I want it to appear. Panel. Then you click on these settings here. Then you change this length from 9 to 200. Then you press enter. So as you can see, so in determining the directional bias of market using indicators, it says that if the price is above the 200 moving average, indicates that the market is actually on the buy side. So you focus more on buying. But once the market has crossed below the 200 moving average, then you think about selling. For it, as you can see right here, price actually went here, came here, then broke. Right. So you're seeing price actually, kind of moving towards the upside. So this is how to use the moving average. So if you are a trader that use the moving average, I would like to communicate with you. I would like to know how you use it. So comment down below. Tell me how you use the moving average to determine the directional bias of the market. So as I said, the most important thing about directional bias is looking at your higher time frame. Right? The importance of higher time frame is just like, for instance, now that I'm in Africa and I want to go from maybe Nigeria to the US, or Nigeria to UK, or Nigeria to South Africa, Nigeria to Asia, anywhere. So in your destination, you must have your starting point and you must have your end point. So whenever you're determining your directional bias, you need to know, where am I coming from and where am I going to go. You don't just determine the directional bias by just as directional bias. You need to know where you're starting from, where you're going to stop, where you know that, okay, this is where I'm going to put my stop. When the market reaches this end, then I'm actually going to stop trading. I'll wait to see what the market actually does. Right? So you need to understand, where is the market coming from and where is the market going to. So as I've said, if you are someone that uses indicator or use the moving average as a way of determining your directional bias, leave a comment down below and tell me how you actually use it. All right, so let's go to the final one. This one is very important because this is what I use to determine my directional bias, and as a funded trader, that has made me thousands of dollars in the market. So let's get right in. So this is a third method of determining the directional bias, which is the use of order block and the head and shoulder pattern, or the W and M pattern. So what this means is that, for instance, the ICTs and the SMC, that is, they understand order block as the position where the big market actually plays pending orders. They know the price will actually come out to that location and finally move to the right direction. Right. So then the head and shoulder pattern. So the head and shoulder pattern goes like this. It actually goes like this. Here is the head and shoulder pattern. It actually goes like this. That is right. So this is the shoulder. So this place is actually called this is the shoulder. So that is the shoulder section. Then here is now actually the head. So that is it. Then also in the inverse head and shoulder, definitely. So it's still the same thing. So this is it. Then also the M and W pattern. So this is the M pattern, and this is the W pattern. This is the W pattern. Okay, so this is it. So now the other block, right, is actually, this is what's meant by other block, like marking a swing low or a swing high. So this is what you call a swing high, you would call a swing low. So you just mark a block. So this is what it means by other block. But to be sure that an other block is valid, you must make sure that the swing low or the swing high must either have a head and shoulder pattern or a W and or M pattern. If you can't see this pattern clearly, I will not advise you to actually use that swing low or swing high as to draw your order block in that swing low or swing high. For instance, you want to draw your order block using the head and shoulder pattern. So this is how we actually go. So you, from the shoulder, you draw it, then you go like this. So we're expecting price to actually come to this side, come here, test this place, and finally move to the other direction. So for this one also, if you want to draw order block, you will start from the shoulder down like this. So we're expecting price to actually come from this place, test here, and finally move to the up direction. So coming to this area also. So now this one works more for what is called the breaker block. So a breaker block is an order block that fails to hold the price. So a breaker block is a block that got broken by the price. So for instance, I told you that order block actually starts from the swing low or swing high. So because of it couldn't hold it, because they couldn't hold it, price actually broke out of it, and so therefore this place is actually the other block. So now to draw my other block, when I see a W or M pattern, I always focus more on the breakout block. So for instance, I'm going to draw it from here, and so I'm expecting that when price actually comes, price actually come here, drop down, touching and move to the up direction. So same thing with the M pattern. I will focus on here, right, and I'll draw it there. So believing that when price actually comes, you go to come here, test here, and finally move to the up direction. So this is how to determine the directional bias, in the forex market using the tailor. This is one of the most accurate methods I've used in determining directional bias. So for instance, let's use the third method to kind of determine the directional bias of this market. So let me remove it. Okay, so for instance, now you can see that this is actually a breakout block, right? So, and if you look at this, you have a combination of a head and shoulder pattern. You can see it. We have a combination of head and shoulder pattern and a W pattern here. So we have a W pattern and head and shoulder pattern. So what we actually focus on when we're drawing is if you look at it, we're going to focus on the shoulder and the next shoulder, then we'll draw it down. So if you look at this actually fits both the head and shoulder pattern and the W pattern. So which makes this level very, very valuable. You can see that price actually came to this point. Price actually came to this point, right? And it's testing and he rejected and moved towards the upside. So the directional bias for this week is that so gold is actually going to buy this week. Then so let's now go down to the lower time frame. Let's go to the 2 hours time frame. Let's see what's happening there. So looking at it, we know that gold is actually going to buy, right? Because it has rejected from an order block from the daily time frame. So now we're at the 2 hours time frame. So for us to try enter this market, we are not just going to start buying here. No, we're going to wait for a good retracement. Seeing that it has broken this high here, it has broken this high here. So we can see that. So what we're expecting, that price will actually come down to this other block here. So if you look at this, and this is a W pattern here. So we're going to take our other block from this region down here, right? So what we're going to wait for is for price to come to this level and drop here. So when price finally gets to this level, we're actually going to buy. So we're going to buy from this level. Then we're going to stop it here. So this is a simple 1:3 reward ratio. So this is the method I use in determining the directional bias of a trade, to know where the trade are going to buy or is going to sell. So if this video was actually helpful, I would like you to like, comment, and subscribe to my channel. But don't forget, I'm actually going to expatiate more on other blogs and breakout blogs. So if you're interested, I would like you to click on the next video that is showing on the screen. So see you there.